Something's got to give here, Frank, in the oil market. So yesterday, you're exactly right. We're going to talk about shipping here in more detail, the shipping stocks. But listen to this from yesterday's Wall Street Journal, Frank. Last month marked the first time since 2006 that the S&P 500 energy sector has traded within 3% of its 12-month high, while the price of West Texas Intermediate retreated more than 25% from its one-year peak.
And what was the first part of that?
The first part of that is that it's the first time since 2006 that the S&P 500 energy sector is trading within 3% of 12 months highs, while oil is over 25% lower.
Yep.
What does that mean? You have this huge break between oil stocks and oil prices. Now, why is that? Oil prices in the short term have gone down. They hit 130 after the Russian invasion of Ukraine. Now they're in the 70s-ish. You've had a lot to do in between there. You had ups and down production cuts by OPEC and announcements. You've had the Strategic Petroleum Reserve release from the Biden administration. You've had some increase in drilling here in the U.S., which is good. And then you have other sanctions around the world. To your point, something has to give. I think the risk on the next move in oil is higher than lower, but I've been wrong on that. But here's the crazy thing about investing. You could argue, hey, Daniel Creech has been dead wrong on the price of oil in the last 3 to 6 months. Yet I'm still correct on ExxonMobil and Dollar Stock Club. We're still correct on Arch Coal, different, obviously it's different energy. And my point is that the market is always forward looking. And what's going on right now is the sanctions that just went into effect this Monday was the cap on Russia oil, seaborne Russian oil. Mm-hmm. So now the U.S. and the European Union got together and said, listen, basically the Western insurance companies control 90-ish% of all insurable seaborne traffic. What is into effect now is that, hey, these companies can't insure a vessel unless they can prove that Russian oil, if it's Russian oil, that it was purchased for less than $60 the barrel cap. Okay. The irony here is that the $60 is higher than where Russian oil is trading currently, and it's higher than, I believe, the 3-year average that it's been trading at. Mm-hmm. So that's kind of ironic. In their defense, the politicians are saying we don't want to disrupt the flow of oil. We just want to try to negate Russia making too much money. Right now in Turkey, even if it's not Russian oil being carried through straits and different paths, Turkey is holding up. There's a traffic jam. We joked about this yesterday. There's as of yesterday, there were 16 to 18, depending on who you're reading, tankers holding equivalent of, let's say, 500 to 800,000 barrels or up to 2 million. Mm-hmm. So very large crude carriers, VLCC, carry 2 million. The Suezmax carry 1 million. And then you got these LR2, sorry to, I don't make this up, people. Follow along with me here, that hold 500 to 800,000 barrels. The odd thing about sanctions is just like every other government policy, Frank. A, you got to try to implement them. B, you got to try to enforce them. And then is there any repercussions and or accountability? Oilprice.com, freightwaves.com, Splash 24/7. That's a good name for a website, in my opinion. They're all talking about, hey, this is all basically just honoring your word. So you stop me and I say, yeah, this is a piece of paper. We bought it for $59. It's Russian. We're good. There's no port authority. There's no international agency right there. Mm-hmm. So it's all just this murky ways. I say all this because Nordic American Tankers, NAT, we've talked about, Ardmore Shipping, ASC, we've talked about, Frontline Holdings, FRO. They all reported very good earnings. And I'm going to give you some numbers here, Frank, about the irony here as oil prices, remember, yearly lows. Okay. Mm-hmm. Tensions, not all-time highs, but let's just say highs. Mm-hmm. Nordic American Tankers focuses on, they have about 19 boats that carry 1 million. They have the Suezmax, okay? So each boat basically carries, we're rounding here, each boat carries 1 million barrels of oil. Frank, in Q2 of this year, they were getting a daily rate of $20,080. Mm-hmm. Okay, that was Q2. In Q3, the most previous recorded earnings was $27,850. So about 38% quarter to quarter.
Day rates, yeah, guys.
Day rates.
That's the shipping that, okay.
Yes.
That's how much they cost for the ships, yeah.
Year over year, just to show you the volatility. So 20,000, 27,000 last 2 quarters. Go back to last year, that was $7,800 during the second quarter and $5,800 for Q3. Mm-hmm. That is a volatile environment. Mm-hmm. It takes Nordic American Tankers. How long are those
contracts for?
Well, so they can be months or years. Mm-hmm. And on the spot rate, so you have time charter rates, which is, hey, I'm going to give you this boat for the next 2 years. Mm-hmm. And then after 1 year, we have an option to increase that. The spot rate can be, it depends on voyages at that point. The wild thing here is, Frank, Nordic American Tankers, it's $8,000 a day for their cost. Okay. Well, obviously last year when you're at 7,800 and 5,000, you're losing your losing your butt. Now you're at 20,000, 27,000. To start the fourth quarter, Frank, which we're currently in, on their conference call, they said that 74% of their ships are already booked for this current quarter at $54,000 a day rate.
And they were getting 5,000
a year ago. They were getting 27 the previous. So in the last three quarters this year, it's gone from 20 to 27 to now 54. Okay. They're going to double their dividend. Now, the good thing is that
dividends, I mean, it's over it's 4% now.
Right, but they're variable. So as you always say, hey, you can't just go chasing for yield because there's a lot of oil companies, a lot of
percentage of profits, a percentage of whatever. So that could be, a dividend of nothing, 5%, 9%, or whatever.
Exactly, because you can say, hey, this last quarter, this is paying 9%, but if they have a down earnings and you don't get anything, obviously the stock's going to crater. What I don't like and why these aren't buy and hold forever. Frank, you have young kids. These are not stocks you buy and hold and, give them to when they grow up and get married or, whatever. Because they're trading vehicles more the less.
Yeah.
What I like about this is that they've very similar to the oil producers. They've kind of found, I love John Petrides in your interview a week or so ago when you guys talked about finding financial religion in the oil patch. Shippers have done essentially the same thing. They're cutting down their debt. They're paying down debt. The problem I have, one red flag, is with Nordic American Trust and Nordic American Tankers, NAT and ASC. They do these at-the-market offerings, which just issues more shares. And what does that do to shareholders, Frank? It dilutes the shareholders. They've both come out, both NAT and ASC have come out and said, listen, we don't need to do this for the foreseeable future. The only reason we did that was because last year day rates were so low. We didn't want to take on additional debt. I can understand that. The shipping area, they're all headquartered outside the U.S. for certain reasons. The shipping area, you know this more than I do, Frank, but it's a gray area. They use a term called shadow fleets.
It is a gray area. These companies are, these companies, it's not that
I'm not trying to be rude,
numbers, but it's for me, it's always, but it's a cyclical industry, right? And right now, but
exactly.
And I think even, listen to you here is when I was bringing up the chart for Nordic here, and you see like the low was 140 and the high was almost $4 and it's $3 now. It's actually down 12% yesterday.
Yep.
And it's up a little bit today, but a lot of people think like, hey, that's the cycle, but we might be in the fourth inning of the cycle where we could easily see like a double or triple from here from these things, and with day rates. So, you're saying what oil companies, you have to look at oil companies, right? So what do oil companies do? And they're really smart. It's almost like the Walmarts and everybody else, right? What do they do when they have large fleets, right? Some of these large retailers is they want to lock in oil prices, right? So go to the futures market, and when you're locking in those prices. You want to obviously do it at low prices when you're Walmart, but a lot of these companies, when oil is trading higher, you're locking in those prices. So you're hedging, and those hedges could be for a year from now at much, much higher prices. So what you're going to see is even oil comes down, and this is one of the reasons why I remember I spoke at a Stansberry conference like a year and a half after they let me go there. And it was funny because I said there, and I was like, anyone who owns oil, I think it was like 2014 or something, it was right like near the top. I said, anyone that owns any oil company, I don't care if it's a major or whatever, and I knew a lot of people did. I was speaking for another company. They didn't mind I was there. I said, you should sell everything oil right now. Sell everything out of it. And they were like, you're crazy. I'm like, listen, the hedges are about to come off. And when they come off, they're going to have to lock those things in at $34 cheaper, right? So now it's a different scenario where, even though we're at 70, you're saying, how come these oil companies are still staying up? Well, you have to look at the hedges. I know there's companies, I think there's Continental that never ever hedges. But some companies do hedge. It could be great or it could be bad. It's more consistent, right? Because I know uranium companies who don't hedge either. And if, again, so you're going to see, a higher beta, meaning if oil prices go higher, the companies who are not hedged you're going to see those stocks move a lot higher compared to the companies that are hedged, and vice versa if it reverses, right? So, but right now, even with the hedges in place, and you're looking right now with these companies, like you're locking them in, like you said, at 50,000. If they're locking them in for a year, I mean, the cash flow is going to come in for this company. The dividend is going to be skyrocketing. They're not issuing any more shares. If this continues into next year, even a few quarters, I mean, this thing could, you look at 5,000 last 50,000 now, and you're still seeing that demand. You look at a sector within the oil market that I feel like not too many people talk about, that could really explode from here. And now you're getting a discount. Here's Nordic Tankers, one of the biggest in the industry. That was $4 and now it's $3, right? So, Again, you could look and say, "Oh, it was $1.50 and I missed it, Frank." But it was, recently at $4. Now it's pulled back significantly. But the fundamentals are still there for these guys, and people may be looking at oil, right? Daniel is saying the oil price is coming down. Oh, I want to get out of this. Not necessarily, because we bottom out here, and you see oil prices go higher. Again, it's the industry is in good shape, especially looking at hedges, and you have to look at hedges. And for me, I was able to make, I would say, a very, very good call, probably one of the top 5 calls where oil absolutely collapsed, because I read a 150-page Goldman report, and I did a ton of research on it showing all the companies of the hedges that were coming off, and I was able to actually pinpoint which companies to avoid, which companies to buy puts on, and which companies were really well positioned for another year or so. And it mattered.
Yeah.
I mean, you saw it wasn't like every oil company went higher. It was, it was a very good indicator of how to pick winners and losers in the oil industry and the hedging. I understand that if you're an individual investor and listen to this, you might not have access to it. You could if you Google it just to see, but you could go to the conference calls, and when you see the transcripts and you get Seeking Alpha for free, there's other places you get it for free. They usually tell you their hedges there every quarter, how much to hedge and how long to hedge. That's something to be looking for too as oil prices come down, because it means those profits can stay relatively high, and you're going to see these things really beat earnings estimates next quarter because they're locked in at much higher prices. But again, you have to dig in and do the research and do research in different sectors. But I know you've been all over this sector, but this is very interesting to me.
Well, it's just odd because what I'm continuing to think through is you have these day rates that are skyrocketing. Okay, that's impressive. That's good. But the market's going to price some of that in. Regular guest and good friend of yours, Frank Holmes from U.S. Global Investors. Mm-hmm. Frank, he wrote an excellent piece just earlier this month on December 2nd. He thinks and is kind of speculating that day rates on different types of oil shippers could hit $200,000 a day next year. Now, they're different worlds. So ASC that we've talked about does oil and they do chemical products and things like that. Nordic American Tankers focuses on oil. My point to...
What was the symbol of the other one?
ASC and NAT.
Okay, so ASC,
FRO is another one.
Yep. This is Ardmore Shipping. Again, if you're on a YouTube channel, we show charts of this and show just some of the research and show our Capital IQ, and you can see different... Another couple, International Seaways, INSW, and Scorpio Tankers, STNG, or a couple other ones. 3 to 16 was the high, but now it's under 14.
And what's interesting, if you're looking at those, every one of those yesterday sold off hard. Now, why did they sell off? I don't have a crystal ball, but here's what went into effect on Monday. We talked about the price cap. We talked about this ship log jam outside of Turkey. Depending on these contracts, if you're not delivering them on time or their fees or their fines, whatever's going on, some of this, I've been checking our Capital IQ systems. I've been checking all the companies for SEC filings and press releases. I haven't seen anything on the tanker jam right now. But Frank, going forward, one of the reasons I'm continually bullish on day rates to continue higher is that as the smoke settles and everybody gets kind of more of their bearings around these sanctions, the newest sanctions in place for Russia. And let's not forget, in February, more sanctions on refined products go into that. That'll be a whole different world. But right now, there's so much uncertainty. And on these conference calls, the shipping contractors are talking about, well, if we have to take different routes to transport from different ports or different areas, that's going to take longer. Frank, if you're a semi-driver and you used to do a trip from here to Jacksonville or here to Miami, and now you're going to start going from here to Cincinnati, Ohio, or here to Maine, that's a hell of a deal. Yeah. You're not going to charge the same amount for that. It's not going to take you the same amount of time. So there's a lot more uncertainty to be unfolded here. However, uncertainty is great for energy markets. Earlier today,
that's true. We always say uncertainty is terrible, but it's
terrible for stocks in general, but it's great for energy markets.
It is great for energy.
Earlier this morning, Frank, the Keystone Pipeline got shut down because there was a detected a leak. Carries 600,000 barrels roughly a day. Guess what? Oil spiked right away. Natural gas spiked right away. I'm not saying it's going to remain there, but my point is that we've talked about this in the past. We have such a tight market, meaning supply and demand is so closely knit that any variation is going to cause a lot of volatility. And the main driver here on oil prices remains to be OPEC, and they're going to do what they have to do to keep Brent, world oil, closer to $90 a barrel. It's not going to be there 24/7. So don't say, oh, well, they just kept quotas on the December 4th at the same as they did last month or whatever. But my point is that there is so much uncertainty around here. It's basically like we're sitting here smoking around a bunch of gasoline and just not anticipating anything. And that's why, I want our listeners to not only get some exposure. So yesterday on the down day, I bought a little bit of ASC and NAT as well, just because I want exposure to this over the next couple months. We can check back in, see if I look brilliant or silly, Frank.